Welcome back to the Educated Home Buyer Live, where our goal is to help you buy right, borrow smart, and build wealth through real estate ownership and financing. This week we have Mr. Josh Lewis back with us. Josh, welcome to the show.
Jeb, I'm going to have to say that of all of the bad music you have forced upon us,
That one was pretty bad, wasn't it?
That was the worst. There were actually annoying little children that sound like they were trapped in purgatory, like mumbling in the background. Like,
that's fantastic.
I think you're trolling us with this stuff at this point.
That was my kids. Hey, dude, try to find good free music on the internet. It is difficult to do. And that's not even free. I have to pay for that garbage. So just so we're being clear. But anyhow, guys, welcome back to the show. Many of you know we're here to answer real estate and mortgage related questions, give you our thoughts on the housing market. Over the last week, we've received a couple of different updates on the housing market, and which has created the title of this video, which is we are in a new market. We've received existing home sales reports, which were declining, and we kind of expected that based on what was happening with the number of sales. We had the Fed come out and basically saying that a soft landing is very challenging at this point. You got housing affordability hitting a 15-year low. And lastly, rates continuing to be unstable and rising. So Josh, why don't we start the show by talking a little bit about interest rates?
So there's the fun part. We got that hot CPI figure a couple of weeks ago. I think it actually came out the day that the last show that I did. Then a little bad day in the bond market the day after that, and then Friday and Monday, the bond markets looked up and said, "Hey, this is not good," which is what kind of forced the Fed's hand to go to a 3/4 point hike versus the half planned. And it certainly sounds like they're going to go 3/4 next month. And this is the part of the show where we just reiterate that mortgage rates do not follow Fed actions. They led the Fed in this case, and then the Fed has brought back a little bit of credibility and gave us a little bit of improvement. We've been talking here for probably the better part of 2 months that we think we're nearing somewhere near a peak in mortgage interest rates, and that hot CPI figure definitely gave us another bump. So to answer the question, let me sort of step back to where we are right now in terms of treasuries, because mortgages never get too far away from treasuries, but there's some interesting things happening right now. So we saw an unexpected rally today in bonds, and the 10-year treasuries at 3.16. We had got almost to 3.5 a week or so ago before the Fed acted. So you see the bond markets saying maybe the Fed's losing control of this inflation fight, and rates spike. Fed takes action, they kind of like it, and they improve. So what we've said all along is somewhere around 3.5, 3.65 is probably a ceiling on where treasuries are going to go. Now, Jeb, you and I have talked a lot about what does that mean for interest rates. That spread, it's sort of a caveman style of figuring out where rates should be. But normally a 3.5 10-year treasury would tell us somewhere around 5% on rates. When we were at 3.5 the other week, we were up around 6.25. So it's a bigger spread than normal. The reason for that is that lenders don't believe rates are going to stay at this level. So when you see volatility in the bond markets, lenders don't want to pay a bunch of money for mortgages. They'll do it for treasuries because there's no prepayment risk on treasuries. But on your mortgage, there's absolutely a prepayment risk. We talk all the time about the good thing about a house is you can fix the price and then roll the interest rate down as you go, as the market improves over the years. But that's a bug, not a feature to the lender making the money. They are lending the money. They want to know where they're at. So long way of saying.
And with that said, Josh, I'm hearing a lot of lenders right now use the quote, marry the house and date the rate. Basically means find the right house, date the rate for now. And as the rates at some point, in theory, come down in the future, you can get a lower rate, marry the rate at that point.
Absolutely, and it's a theory because none of us know it to be a fact, but it's a real good theory. When you see every day we're getting softening numbers in consumer confidence, softening home sales, and this stuff is related largely to interest rates. The interest rates are high because of inflation, and the Fed and President Biden can point to some things that were outside of their control that have led to it, but a lot of things they absolutely do control. So we're looking plus or minus 6% on a conventional loan right now, depending on how well qualified you are. Probably the biggest issue that we're seeing is if you have a lower credit score, or if you're buying an investment property where there's a lot of loan level price adjustments, lenders are not wanting to pay up for higher note rates because, again, they think those are going to run off or they're unlikely to stay on their books. So you're seeing more loans quoted with a point. I had a VA loan this week that we had to do with a point because if the borrower didn't pay the point, instead of normally we could go up 1/4% and avoid that, we had to go up almost 5/8% to avoid it. So that's one of the unique things that you're seeing in the market right now. So your government stuff is low to mid fives. Your conventional stuff is plus or minus 6%, depending on how well qualified you are, how much you have to put down. And we have some good portfolio options right now. And Jeb, something that you and I didn't talk about today, and I don't know if it made its way to Housing Wire or anywhere else, but last night, our friends over at United Wholesale did one of their about every 6-month pricing wars that they like to kick off. So as of today, on the wholesale side, brokers have access to a lender called United Wholesale. Retail lenders are really struggling with margins and lower volume and heavy overhead. United Wholesale saw this as an opportunity to arm brokers with even lower interest rates and make it really hard on retail lenders in the current market. So we have 2 lenders that are incredibly well priced. And as of this morning, United Wholesale is a 1/2 point better, not in interest rate, but 0 points with one of those lenders who was already really well priced is like a 1/2 point lender credit with United Wholesale. So if you are in the market and you haven't talked to a broker, make sure you talk to a broker. It's definitely worth looking at. The spreads between retail and brokers are usually significant, especially on higher price points, but they're especially significant now with that product being available.
Good stuff. So always, again, it's good to talk to multiple people like Josh mentioned. Now, something I've noticed being on the real estate side is, obviously there's a slowdown out there. I think we've all experienced it. If you've been in the market, if you've been to open houses as buyers, less people out there shopping, less offers, buyers taking longer to make decisions. Partly due to the change in market, no question, right? When interest rates go up that much, that quickly, it puts the brakes on things. And I don't think we've seen the true effects, right? I mean, we're still, seeing year over year appreciation numbers. And the way they do that is somewhat misguided as far as I'm concerned, because now the market's, decelerating, if you will, but yet they're still showing year over year, reaching new levels or what have you, but that's a whole different conversation. But what I will say is that inventory, I feel like, has not peaked, but it has definitely slowed over the last probably 10 days to 2 weeks. The number of properties coming to the market has slowed considerably to, say, the prior month, 2 months leading up to that. Part of it is, again, buyers looking to get their homes on the market, or sellers rather looking to get their homes on the market. And so they've done that in the spring, but now you're starting to get some of the seasonality play, right? If you go back and you just took all the numbers away and you just looked at the ebbs and flows of the market is starting to fall back into what we would have said 2 years ago, 2.5 years ago was a normal pattern, right? So you start the year, low number of homes, it climbs into, March, April, May, and then it starts to decline a little bit as you head through the summer. And then maybe you get a little bit of pop at the end of summer, which you typically don't really do. It's more of a stabilization. And then things kind of, again, just continue to move down with regards to inventory, the number of home sales, all of that declines into the end of the year. And then that cycle starts over. Last year was different because, summer ended and people came back and started buying homes again. We thought, midsummer last year, we were talking about, hey, things are slowing a little bit. And then all of a sudden we got the big pop. This year, I think you're just going to continue to see the slow, but I don't think you're going to see the inventory build quite like people are expecting, just because of how low rates are and where people are locked in on some of these, interest rates. I'm having the conversation. People are posting on my videos saying, why would I give up what I have here to go buy something that's more expensive and pay a much higher rate? And that's the mentality that's going on out there. And so, yes, a slowing is going to happen, but its inventory, again, I'll say it, and we've been saying it for 2 years, is still historically low. It's going to build, but we're still a long ways away from any sort of levels of inventory that's going to cause a big decline in prices. So just, and then somebody commented a moment ago in the chat, and I flagged it, and I'll throw it up here in a minute and ask about the days on the market, how the days on the market, if you look, at the National Association of Realtors, isn't really moving. It shows that the days on the market are still really low. And I looked at that as well and thought that's really confusing because the days on the market are going up. It's one of those indicators that I don't really pay so much attention to because I'm in the market and I kind of feel what the days on the market are. But I can tell you that the days on the market that they're posting don't look accurate to me. It looks like, we've seen the days on the market here locally probably add 2.5 weeks to those numbers. We're probably sitting 35, 40 days here locally for days on the market, where it's still posting like 17 or 18 days. So just keep that in mind. And then anybody locally, Orange County today, 3,323 homes, Huntington Beach, 211. So both of those numbers are pretty close to where they were last week. Not a big change there. And that kind of goes along with the slowdown that I was talking about.
Jeb, I have, this is funny. My wife and I were walking around the neighborhood and we haven't seen a spike in listings, but there's a few homes listed around the neighborhood. And unlike, 6 months ago where you're like, that is an absurd price. Everyone seems to have settled in and said, this seems to be a reasonable price. But it got me to thinking, some of the additional inventory that's coming to market now, and it's not just a matter of less homes going under contract. There were, for the last 6 weeks or so, more homes coming into the market. And I started thinking, there are a lot of people who were holding off, like they wanted to sell, but they're like, well, if it's going to go up, I'm just going to keep waiting. And what we're going to find out as those come on the market, how many of those people are interested in selling versus committed to selling? Because it seems like some people were like, these numbers are so great, but they haven't really done their research. Like you were talking about, where am I going to go? What am I going to pay? What's it going to cost? And am I really going to get the crazy number that I expected? Because as we're sitting here, everyone's used to June, July being the highest price months, if you look at seasonality and price, because those are the things that are going under contract late in the spring, early in the summer. So there's a lot of that. I'm going to wait and just see if I can get into the summer. For me, that property that I own in Orange, we ran the lease right into May of next year, so that if we wanted to sell, that's when we would come on the market. So what are your thoughts? Do you think any of the pop in sellers was some of those people that were holding on, wanting to squeeze out a few more dollars and
Sure.
feeling like they missed that opportunity?
Absolutely. There's greed in all of that, right? Wanting to get the absolute highest price and not having to do it at that time. So waiting a little bit longer. I think there's definitely some of that. There's fear, right? People seeing, the headlines, the market's crashing, the market's slowing, the market's shifting, the market's whatever the title is. And people are like, crap, like, I don't know, I'm going to sell. Like, now's the time, and throw their homes on the market. But what I can tell you is that even the homes that are coming up, nothing to me, like, I haven't seen a price where I'm like, wow, that looks like a good value for that property. I mean, and that sounds absurd, because I mean, I've been selling these properties for the last couple of years, but it's still like the numbers out there that sellers are still asking for properties. Granted, I mean, there's comps to support it, so I get it, but it's just, the numbers are still really high, people. There's no big declines in prices, and if you're out there looking, you know it. And I think that's part of, you know, um, the hurdle that buyers have to get over, is that, not only are rates up, prices are up, and prices probably aren't really going to go too far. So the question is, do you buy now, or do you wait and hope that rates come down at some point in the future, and then the demand doesn't come back? And that's the question that everybody has. Everybody says, well, I'm going to be a buyer when more inventory comes, when the right property comes, I'm going to buy it. And like we've said, Josh, when the rubber hits the road and rates double, and then more inventory comes, people are like, shit, I don't want to be the first buyer. I'm going to sit and kind of see how this thing plays out. I'm a bit scared. And so you've got that, and then you've got people, just the affordability play. So there's a lot going on, and a lot of it it's mental, right? I mean, it is the mental hurdle of pulling the trigger and saying, yeah, I'm going to do it, because it is scary. I mean, and there's remorse. There's real remorse when you buy a house. I don't care how much you love it. When you sign that contract and you go under contract, it's a big purchase. And so you question whether or not it's the right decision. Even in a market 2 years ago, when people saw price gains, year over year, since then have been 30%. Those people questioned what they were doing at that time. And so you're not alone if you're a buyer out there just questioning whether or not it's the right time. You just got to, again, we've talked about it, have that longer term time horizon, and not be stretching yourself too much.
Other than homes that we were going to flip and be in and out of in 2, 3, 6 months, I've never signed a set of loan docs for a property that I was going to hold and sat there and gone, this feels awesome. It's a big debt. No matter how much you love the property, and like in almost all of the homes that I own, we've owned for a long time.
Dude, I have remorse when I buy a $150 pair of shoes. Like, I buy a pair of shoes and I'm like, shit, that was a lot of money. Should I have bought a pair of shoes that were
You're fancy.
$150?
Why are you buying these expensive shoes? Go to
Dude,
Walmart.
every pair of workout shoes now is like $150. Like, every pair. It doesn't matter what brand. They're all $150 minimum. And I'm being facetious when I say the remorse thing, but it literally, I mean, when you have a purchase and we're talking hundreds of thousands of dollars, it's normal to have some sort of weird feeling whether or not and then you got all of the headlines playing into it. It's a scary time, people. But we're here to educate and guide you. So that's what we're going to do now. Josh, let's, I flagged a couple questions here that we can go through.
We got 14 of them.
So this one's a good one. This one I want to start with, because this one's, there's no clear cut answer to it, but it's something that I've asked myself. And that is logical thinker coming in and said, what do you think Powell meant when he said young people looking to buy a home need a reset? So when I think that, I immediately think buyers, well, because I'm more bullish on housing probably than anything else, buyers need a mental reset on what the market looks like now because of rates being higher. That's what I think of. Like, buyers need a reset. But what do you think he meant? Do you think he meant house prices need to pull back? Do you think, what do you think he meant by that?
So Malden, in his newsletter the other week, had a chart of the lifetime real world experience of every voting member of the Fed. Do you want to know how many of them have ever worked out in corporate America, real world, in jobs?
Oh, it was only a couple. 2, 1, 0? Oh, okay. Yeah. I thought it was 2, but
yeah. It was 2 that had some sort of kind of experience, but it wasn't. It was like a university or something. It wasn't real experience. So when you look at that, these people are so out of touch that he thinks he's extending an olive branch, saying, "Hey, we got to look out for these younger people. We need a reset here." I think he meant it. I think he meant that. Here's the upshot to this: is that we'll put the stop to the housing market, because really they have and they will. But what do I say? When I say they, it's not the Fed. The Fed's actions the last 2 years pushed home prices this high and pushed inflation this high, and the bond markets were going to react with rates this high that will cause what's coming next. So it's not like I'm giving them credit for it because they caused the problem.
Right.
You and I had talked just earlier this week that how much demand was pulled forward from the next couple of years. Not everyone is able to expedite their timeline. If you say, hey, I'm going to buy when I'm 26, I'll be finished with college, I'll have 2 years of work, and I'll know where I want to settle. And it gives me time to save a down payment. Maybe you don't have the ability to move up that timeline. But some people over the last 2 years rightly looked and said, hey, I want to wait until 2023, but that's not realistic. These prices are going up fast and rates are really low. So we all of that. Your question was specifically about Powell and what did he mean by it? I think he meant it. They caused a problem. They're too dumb to admit and acknowledge how and why they caused the problem. And he thinks that's an olive branch, but not realizing that we've talked before how important it is for the Fed to not have housing take a big dip, because not only do you have the jobs, people don't realize how many jobs are related to housing. Even just places like Home Depot and Lowe's do very well when home values are up and people are investing in their homes, even when it's a do-it-yourself project. You've got construction jobs, you've got mortgage jobs, but we've had a plenty of good time for the last 2 years. I'm not saying feel bad for us, but there's that, and then you also have the wealth effect from home values being high. I don't know if you got a chance to read that report I sent over earlier today from the American Enterprise Institute, but I didn't dig into the footnotes of how they quantify it, but they have a predictor of how long the wealth effect will last, and they're saying for the lower quintiles of homeowners, so they break the population into 20% groups, and on the lower income groups, they're saying the wealth effect from homeownership is gone. They're saying the top two quintiles are likely to feel it through the rest of the year as higher priced homes go up, continue to go up in value, while lower priced homes, due to affordability constraints, are going to have a more difficult time.
No, I started diving into it. I didn't get all the way into it, but yeah, I'll take a look at it and we can talk about it more. But I mean, the Fed, what the Fed did, when they interviewed Powell earlier today, basically said, again, a soft landing is, what did he say? Very challenging. It was his word. So for anybody out there watching, what he means is a recession's coming, and, they're not going to come out and just say that, but that's essentially what you have to look forward to. So again, this is a time when people cut back on expenses that aren't necessary. And it's going to take, again, you're not going to see this effect in the market for 6 months, 8 months, probably, really, when people really have to tighten the budgets. And it'll be interesting to see what it has. A lot of people believe it'll be a short-lived recession, one that's not, it doesn't have a huge impact on versus being more of a shallow type recession. So less impactful, if you will. But it'll be interesting to see. And we've got some questions related to that too, Josh. Someone asked earlier, let's see if I can find it, about layoffs. So, we're in one of the best employment positions we've been in decades with regards to the number of people employed. So what do you think? A recession, right? Obviously, layoffs happen. Is there a huge impact on housing at that point? I mean, I see. Here's what I struggle with when people talk about layoffs and recessions and whatever. Right now, almost every business out there has some sort of help wanted sign. Even in a position where we have some of the best employment we've had in decades, people are still looking for good workers to come in and work. So when you have job layoffs happen, how many of those people getting laid off won't be able to actually go find a job? That's my question. Is like, you could get a job if you want one. Or are you under the mindset, well, I got laid off, so therefore I'm not going to work and I'm just going to collect unemployment?
Hey, you said you paid for a Bloomberg subscription, didn't you?
Yeah.
I got to send you the link. I've read too many of them, but they ran an article today that was saying that the Fed's preferred measure of unemployment is overstating the tightness in the labor market. We're seeing, like, if you look right now, you look at the companies that have had major layoffs. fintech and mortgage,
Right. Yeah.
heavily represented there. So a lot of those people, it's not necessarily, you don't have a fintech skill set. You have a skill set that was largely absorbed by fintech companies here recently. So those folks should be able to find jobs in other industries that are less impacted. If I were to sit here and guess of what's next, I think we're going to head to a recession. I don't think it's going to be a tremendously bad recession where we see unemployment spike to what in the Great Recession we were up at 10%. If we went from 4 to 7, that's about half of what the Great Recession looked like, and that's probably somewhere along the lines of a worst case scenario. And what you end up seeing, Jeb, to your point, was it's no one goes through and says, I guess when you're a big Fortune 500 company, you're going to cut 20% of your workforce. There's obviously some good, valuable employees that are going to lose their jobs there. But if you have a 20-person workforce and you're going to cut 20%, you're going to go, who are the 4 least valuable people around here? So from that perspective, most of those folks, your stable homeowner types are going to be safer from that. Like if you go back, so even though in the Great Recession we hit 10% unemployment, that was largely driven by lower income levels were impacted at higher rates, and then also lower education levels. So we don't want to go down the rabbit hole of student loans and education and that whole boondoggle right now, but homeowners tend to be older, more educated, higher net worth, higher incomes. So it will impact housing less than it will impact other things, but it would be foolish to say it's not going to impact it at all.
No, and all those mortgage people can go back and get their jobs at wherever they were working prior to. I was going to say some jobs, but I decided not to and hold off and be nice on where they were probably working prior to coming to mortgage. But when the times are good, there's a flock of people, real estate mortgage, and then a lot of those people, unfortunately, aren't going to be in the business here in the next 6 to 8 months just because of the changes happening. But anyhow, let's move along. So, Josh, we got Andrew saying, have you noticed? Oh, this is the median time on market. So I did notice this. I believe the data, again, I don't believe it's accurate. I believe days on the market are higher than what they're quoting at the moment. I'm not sure exactly. Typically it's when a house comes on the market versus when it goes under contract. I see time on the market being longer than what they're noting. So I give it, very, very little credence, if you will, at this point. So we've got, let's see, Jonelli. Watch you guys every week. Thanks for the amazing info. Appreciate you being here. Claudia says, from Riverside, California, ready to buy a house, but now I'm debating between keep on saving money to
might have been
avoid
a talk to
property
text
mortgage
there.
Insurance. It's like reading a license plate. You're really good. And so doing that, maybe house prices will go down a little bit. So, I don't even know if we want to go down this rabbit hole of the idea of saving money to avoid mortgage insurance versus house prices going down. But here's what I'll say. Areas like Riverside, San Bernardino, you're going to see prices more affected in those markets than you are, say, in Orange County, just because, again, we've talked about this before, a little bit further from the coast, a little bit less desirable, if you will, from different standpoints. And so those markets are probably going to be hit a little bit harder. But what I will say is they have less expensive homes. Therefore, more buyers can qualify, for homes in those markets, which should kind of create some stability there. But can you save?
I was going to say, Jeb, hold on to that thought, because in that American Enterprise Institute, he's heavy on this, and he's a data guy. So there's data behind it. He's more concerned for entry-level, heavily FHA markets, just because, like we were talking about, those people are generally younger, entry level. They're more at risk when there are layoffs, things of that sort. So I definitely understand, and I see your logic where you're coming from, but he's the one guy that's repeatedly banging that drum that they see more stress in entry level, heavily FHA markets.
But I also see the other side of that. I mean, clear a bit where more people can qualify for that. So even if you take away some of the buyers that were buying in that price point, now you have buyers that were maybe looking at a higher price point that will settle maybe for something a little bit less because now their affordability isn't quite there, right? Because rates are higher. So now instead of being able to afford the $500,000 home, they're looking at the 425 home, and therefore those buyers shift down. I don't know. I just, that's what I think of when I think of, who's being affected. Yeah, the entry level buyers are definitely being affected, but they're more affordable homes. Therefore, you got more people that can still afford them. I don't know. So, but with that being said, Josh, can you save money as fast as with regards to avoiding mortgage insurance, right? So you need 20% down. So on a what's the median home price now? 410,000 or something. So you've got to have what?
20,000. You got to get 5% to get to the next tier of mortgage insurance pricing. So either to make the mortgage insurance go down or 20% to make it go away. So you got to get to $80,000 on that median price home to make it go away. Another 20,000 to decrease it. What I tell everyone is do not believe the myths you've heard about mortgage insurance, and do not believe the online calculators. They're all over the place. They're all high. Getting an accurate quote for mortgage insurance is really difficult. So make sure, even if you're talking to a mortgage person, say, where did you get this number? Did you look at one? Like, I have one of my lenders that literally has a pricing engine for mortgage insurance. It compares 7 different mortgage insurance companies, and it can be as much as 1/8% difference, 1/4% difference on lower credit scores, higher loan to value. But what I always like to say is, for well-qualified people that are putting 10%, 15% down, mortgage insurance is almost insignificant. Even at 5%, it's generally better to get in versus watching what can happen in the market while you're not building equity either through appreciation or paying down principal. But obviously the calculus is changing. Last year we're at double-digit growth. We're seeing a more normal market. If the market's going up 1, 2, 3% a year, it can be justifiable depending on how quickly you can save. The important part is make sure you're getting a real number based off of your down payment, your price, your type of loan, your credit scores, and the number of borrowers on the file. Because a lot of times people are shocked at how low the mortgage insurance is relative to what they're thinking it's going to be.
No, always good stuff. Let's see what we got here. Matthew, I just clicked Matthew's question. I just canned him by accident. He was talking about the number of credit card offers in there. So basically said, are you noticing the number of credit card offers coming in the mail? I haven't really noticed an uptick, but I know obviously, I heard a commercial the other day for some credit card, and I looked at my wife and I was like, these people are so egregious, and who they were marketing to was so bad. I was like, this is the reason that the Americans are so in debt, is because literally they're offering credit. And I forget what it was exactly, but that's what made me think of it. And Matthew, unfortunately I canned your question. So I don't have it here in front of me, but yeah, the credit companies always come out when times are tough, and you'll see more people taking on more credit. There's no question. Let's see. Josh, Ivy says we locked in 150 days on a 30-year fixed at 3.75 for a new home. The builder stated closing date of July 12th. The locked rate expires on July 13th. Should we pay an additional fee to extend locked rate or risk it?
There's no question there of risking it. If they're telling you it's gonna be within a day, you don't have to extend the rate lock now. We're a month out, so you need to extend it probably a day before. We can extend it the day that it expires. Now, I don't know how your lender or the builder's lender looks at that, so find out how late you have. I wouldn't extend it early because you might buy insurance you don't need, but it sounds like you're likely to need it because the builders get pushed late. So just find out how late you can push off that decision, and keep checking in with the builder. When are they going to get your certificate of occupancy, and when can you close? Because you absolutely positively do not want to risk losing that interest rate. I mean, if we're saying conventional loans are in the high 5s, a 2% difference on a decent sized loan is a ton. You cannot lose that interest rate. So whatever you do, if you have to extend, you're going to extend. Just find out how late you can push off that decision.
Good stuff. Jay Homeboy says, what is your take on a house in Sacramento area? Originally, the price was $680,000 in late May. 2 weeks later, price jumped to $730,000, $50,000 higher. 2 weeks later, price dropped to $705,000. I'm like, this seller is not ready to sell. So here's what's interesting. I have a client right now has a property listed for $550,000. It's a little condo. Her neighbor across the way listed their property originally for $550 and received multiple offers at $550. So the same price as ours. This is prior to us coming on the market. They wanted $575. They didn't get $575. So therefore, they ended up raising the price to $575. So they raised it $25,000 and clearly didn't get the attention that they wanted at $575. So they pulled it off the market. And as of today, about an hour ago, it came back on the market at $544. So they went from $550 to $575, back on the market at $544, which is lower than where they had 3 offers when they originally listed. So people are crazy, just so you know. Sellers are greedy and many times misinformed and don't understand how the market works in some of these situations. And so when you've got 3 people, giving you the price that you want and you want a higher price, obviously doesn't make any sense. So in this case, it sounds like, they came on at 680, maybe got some attention, a number of calls. Somebody said, let's go higher in price and see if we can get it. And they didn't get it and ended up reducing. So looks like a similar story. It's hard to say in this case, whether or not the seller needs to sell or wants to sell. It's just one of those things. It's, people always think they have, but not always. Most of the time, people always think they have the best property. And we're coming out of a market right now, again, where everybody has an opinion on housing, what's going to happen to housing, how they bought their house, what your agent should be doing, what they're not doing, all of that stuff. And so everybody's remembering, again, 6 months ago when there were multiple offers going way above the asking price, didn't have to do anything. The sellers today, a lot of them still think they're in that market and they're not. So I would tell you, make an offer at 680, make it lower than their original offer. Clearly at one point, 680 was a number that they would have accepted, and that wasn't that long ago. So that to me is some sort of, their cards are on the table with regards to a price at some point they were willing to accept. And that was less than, 6 weeks ago. Anyhow, so hopefully that's helpful. And someone asked a question a little bit further down here in this one. David says, is it common to see listings being removed and added back to refresh the time on market? I've noticed a few listings in the San Diego disappear, then reappear. So it doesn't work exactly like that. So here in Orange County, the way our MLS works, San Diego's the same way. A property, when you pull it off the market, has to be off the market for 90 days in order to reset that days on market. So that way you can't just list a home for a week and pull it off and then relist it without the cumulative days on market changing. So you can do it every 90. So just keep that in mind. But no, that's a common thing that happens as the market, we haven't seen it in honestly in a couple of years because homes sell very quickly or have been selling very quickly. So people weren't in a position to have to pull it off and then relist it. But when people price it too high to start with, and then they want to start with the idea of reducing it in order to kind of get that reset, they pull it off. But what I'll tell you is all the websites out there now, the Zillows, the Realtor.coms, what's the other one that everybody uses? Redfin. They all show when it was on the market last, how long it was on there, what price it was on. So buyers have all the information. So it's not like anybody can trick anyone now with looking at days on the market because there's a full history.
Jeb, is it the same, not just with a price change, but with an agent change? So let's say, someone pitches their agent overboard and a week later lists with a new agent. So even though the agent ID changes, it's looking at the address and showing total time on market.
So days on the market stay on there. Otherwise people would just switch agents and say, I want a new agent and whatever. Yeah. So if I take on a listing that's just been on the market, if I want that reset to happen, it's 90 days. So, and in some markets it might be different than 90, but that's what it is here in California. Or in Orange County on our MLS. What is the best way to prevent squatters in California? The best way to prevent them is doing all the due diligence or as much due diligence as you can up front, but there's no hard fast rule that says, you're not going to have a squatter because you do this, but it's verifying credit up front, verifying employment, savings, assets, as well as checking references. I mean, that's all you can do really initially when trying to find a tenant, and you're trying to do all of that on the front side before you get someone. But that doesn't prevent someone from coming in and not paying and just staying. I mean, but again, you typically try to find people that are stable, that have, something to lose, and therefore wouldn't be a squatter. But outside of that, Josh, you have any suggestions?
Treat it like a young gentleman is coming to pick up your daughter for prom. Have a shotgun next to you while you're screening them, and let them know that this home is your job. So this home does its job and puts a roof over them every day, and it expects to get paid at the end of the month.
There you go. I like it. My house expects to get paid.
My house expects to get paid, and this shotgun here enforces its desires.
All right, good stuff. Tai Sue says the chance of recession coming is high. How long does a recession normally last, and what kind of impact does it have on housing, historically speaking? Thanks. So a recession typically lasts about a year. 12 to 18 months, I think it is. Whereas I think the average is like 11 months, if I remember correctly, but it's 12 to 18 months on we'll just use 12 to 18 months, but it's 3.5 years of growth followed by like a year and a half of some sort of pullback is typically how recessions work. Now, what kind of impact does it have on housing historically? Historically, housing has done very well in recessions. There's only 2 recessions where housing has been impacted. And one was the impact was actually caused by what was happening with regards to housing. The recession was actually caused by housing. That was the last one we went through. But other than that, it's fared very well. Home prices have moved sideways to up during recession. So, housing is one of those things that people still have to have, even in tough times. So, especially when rates are super low on what they have, and the amount of equity that people have now, 27.8 trillion is what I saw the last reading. But as home prices stabilize in some areas, they'll come down. Some of that equity will get eaten up, so you won't have quite as much. But the reality is that people, if they need to get out, there's an opportunity for them to do that without having some sort of distress sale.
Jeb, I like your recall. The average recession lasted 10 months, but
Okay.
11 is an important figure. There's been 11 recessions since 1948 with an average length of 10 months. The interesting one, I should Google here how long the last recession lasted.
It was about a week.
Not the COVID 1 week recession, the last real recession prior to that. As soon as I said that,
I think that one was 18. I want to say 18 months. But I don't remember. Maybe wrong. Resume. Look at that. How come Huntington Beach price reductions are so huge? 100,000 or so on a $1.2-1.3 million home. So typically you won't see a price reduction of that much or that caliber at a price that high unless it's just priced wrong to start with. So in this market, I don't think it's crazy on a $1.5-1.6 million house to see over time $100,000 price reduction, because many times those homes are priced higher than where they need to be to get to start with. So some of that is already built in. I mean, in needing to reduce the price before you ever get going. But I would say I don't know what the average price improvement is, but I would say probably 5% is probably the right number, is what I think of when I think of price reductions on a lot of property. For me, it's a little bit about feel. What are other properties selling for in these markets? What are they doing? But I wouldn't say that 100,000 is a normal price reduction or something that you would see often, unless the property is way overpriced to start. Let's see. DKG. I'm trying to buy, but my realtor wants me to offer more than asking. Even now, it's kind of annoying. Can I break my contract with her? So the answer
before you answer, can you break that into 2 different parts? One, the realtor pushing you to make offers over asking, and then talk about the contract with her.
Well, let's talk about So I would ask the realtor, why am I offering over the asking price for this particular property? You know, what in the market is telling you I need to offer over the asking price? Like, show me comps of properties that have sold to give me an idea of where I need to be price wise. Like, I have one right now that's not similar to this, but in fact, they're clients here, and they're working with one of my agents, and they want to offer significantly less than the asking price on some of these properties. I mean, a property just came on the market. Let's just say it was 1.3. They want to offer like 1.15. It'd been on the market 4 days. The comps don't support anything close to where they want to offer. It supports the 1.3 price point. And so the agent's trying to have a conversation with the buyer saying, listen, the number that you're trying to offer it's not supported by the market. Now, I told her, just make the offer. Like, sometimes people need to learn in this market that it doesn't work exactly like you as a buyer thinks it's going to work, especially when they're getting calls. The listing agent on the other side is saying they have offers. Like, okay, don't believe me and make the offer at whatever you want. But if you want my advice as a real estate agent, then you need to listen to it. So if you don't trust your real estate agent, then that's a whole different conversation. But I would find out why. Why are you doing it? If it's a market that is slowing and you're seeing a bunch of property and there's a lot of options for you, maybe you don't need to offer above the asking. There are agents that are out of tune with the market and think it's still what it was months ago. And then there's agents that understand what the market's doing and can see where you don't necessarily have to come in above the asking price. But real estate's local. Like I would tell you here locally in my market, there are properties that you could offer lower than the asking price. And there are properties that are going to sell above the asking price. So which side are you on? Now, as far as the contract goes, that's one of those things that's a little bit more difficult to navigate. I'm the kind of agent, I don't have buyer broker agreements. I don't do them. But if I have somebody that doesn't want to work with me, I let you out of the contract. I'm like, why am I going to tie somebody to a piece of paper that doesn't want to work with me? That's how I do business. Not all agents do business like that, unfortunately. So I would have the conversation and say, hey, listen, I've lost my trust in you, or however you want to navigate it, and say that you're looking for somebody else. And if they won't do it, then you go to the broker and try to go up from there. But most of the time, reasonable people would be willing to work with you. So I don't know if that gave you your answer or not, but that's my answer. Anyhow, let's see what we got here. So Mark Austin says, what do you think of the home investor loans where they take a stake of your equity? I'm only asking because my DTI is too high for a HELOC. So Josh, any thoughts on this?
So if you had asked this question anytime in the last couple of years, you'd say, well, that's crazy, because the appreciation was pretty rapid. So you're giving up a good chunk of a rapidly appreciating asset. If we think that we're getting back to more normal in home price inflation, and even a less than normal period of home price inflation, would we say going back 75 years, it's 4.6% on average. If that number drops to 2 or 3%, you're not giving up nearly as much for this. And if I haven't done research on these recently, but I do believe it is like any other lien. You can buy them out. There is a return in the note or in the security instrument that secures their ownership interest in the house. So you could buy it out if things were to change. Really, it depends on what we're doing with the money. If the house has deferred maintenance and you're going to bring it up to speed, it could be a decent way of doing it. If you've pursued all other options and it's your only way of getting money, there are worse things you could do. But definitely check into the terms. And if there's more than one of those companies doing that, I'd get bids from both of them and see who will take less of your equity for giving you more money.
Yeah, I'm kind of on I don't agree with them. I don't know. I just giving.
I don't love it. I don't love it at all.
Yeah.
I'm saying if you've exhausted every other option for getting your
money, I mean, what are you going to use the money for? It's like, I mean, if your DTI is too high for a HELOC, then what will a HELOC go to these days, Josh? 80%? Or would they?
We have 90, but once you go over 80, you're getting a higher margin.
Right. So I mean, if you've only got that amount of money of equity in your property to begin with, I mean, tapping into what little you have there, I don't know, just doesn't seem like the right move in my opinion. But again, look at your options and see what you think. Let's see. Sagatech says booked a new house by bidding over $40,000 over the asking price and locked in a rate at 5.5%. Is there a chance for negotiating the price or any other assistance from the builder during the closing? So typically, no. Again, we talk about builder contracts being unilateral, very much in favor of the builder. But builders are hurting right now. Many builders are hurting. Some aren't, but some are because, they got a lot of property. The market slowed down. Builders are more willing now to work with buyers, probably more so than any time over the last 2 years. But you're under contract. So negotiating it after the fact is going to be tough. But it's a conversation you can have. You can see what you got to have some leverage against them, right? If they have a bunch of available inventory options out there of properties and nobody's buying them, you've got more leverage in getting them to work with you versus if you're the only, if there's no available inventory out there and you back out, then there's maybe somebody there to take your property. They need to have some fear on their side in order to be able to negotiate. And so I don't really know that you have any leverage other than if the builder's not performing in some way, right? If the timelines have changed, if something they said they were doing, they're not doing, at which point you have some leverage on your side to negotiate. But if you just think you paid too much and rates are just too high and your payments there, you might go to if you're working with the builder's lender or whoever it is and have that conversation, basically just saying, hey, I think this is too expensive or whatever, thinking of backing out. They might do some incentives, but I can't see much happening there. Josh, any thoughts?
No, you don't have a lot of leverage unless the builder gets to a position where people are backing out of their contracts and they have more homes than they have buyers. So really, until that changes, not a lot of leverage. You have a contract.
All right, there you go. Jose says people will start taking interest only loans again. So this isn't a question, it's a comment. And I think it's fair to say that's going to be the truth, right? I mean, when rates go up, people are more apt to take, again, we've talked about it. People, look at the payment versus the price. So if you can offer me a payment that is less than it would be otherwise, even if it's taking an interest-only loan, maybe it's taking an adjustable rate mortgage, that's something that buyers will consider. Now, there's a bad history of some of this stuff because people remember the last time with all the other nuances thrown into lending that made it a terrible idea. But no, the idea of interest only, it's going to come back. People are going to start to consider, ARMs and interest only again because of where payments have gone, because house prices aren't going to go very far, people. And so the idea is how do you make it more affordable? That's how you do it.
You look there. This is to a degree a math equation. So why don't we just throw this one up here because it kind of follows along. Nathan says, being in South Orange County, what's your trajectory as far as price decline? What will be the new norm for a single family home? So there's a math equation, both in terms of supply and demand, and the demand math equation comes into what are buyers able to pay. It's not just a matter of saying, I want to buy, what are you able to pay? So we are hitting the limits of that. Jeb talked earlier, we're hitting a record low levels of affordability. So one of the ways that can correct is interest rates coming down. Doesn't mean going back to 2.75 or 3%, but most people would be pretty stoked if rates went to 4.25 right now. It's almost a 2% drop from where they are, and that's not without historical precedent. It's probably where we may settle out, somewhere between 4 and 5% eventually, which is much better. That will help the affordability equation. We have demographics, and we also have a lot of people set in place that don't need to move. So supply is limited, demand is constrained. So it's pretty reasonable to not expect what we've seen over the last couple of years. Jeb Logan runs through the numbers. He had a projection through the end of 2024. He wanted to see about 23 to 24% total price appreciation.
Right.
We blew through that last year. So that would have been a healthy appreciation based off of supply demand equation. but we had affordability boosted by really low interest rates. Demand came forward, supply didn't pop up, and so prices are elevated. We've talked before on the show, home prices do not have to come down. They can't continue going up because you will run out of potential buyers. But what does it mean? So, Jeb, I told you I looked at a number earlier today. You may remember who put the report out, but they were projecting a 4.5% price decrease over the next 12 months, and then a 3% increase over the following. And the only way you can square that is saying that affordability at the current levels is going to push demand down, where home prices will have to decrease. And then recession kicks in, brings rates down, affordability comes up, and you have more demand for those homes. So none of us know. None of us have a crystal ball, but when you're looking, it is a math equation. When you pencil it out, those are your most likely outcomes. I don't see a big downturn coming. I could definitely see a protracted period of flat prices until we get better interest rates.
Agreed. Yeah, no, I don't remember who put that report out. In fact, I was trying to find it yesterday and I couldn't for whatever reason. I read the same report and never saved it. So I'll try to find it and we can and post it on here for people to check out. Excuse me. Woo! Whoa! Did I sound like Ric Flair?
Yeah.
We're an hour in. Want to ask a favor if you'll hit the like and subscribe if you're finding any value at all. If we've answered your question or you put a question in, we'll get to it. Hit that like. You think Josh and I suck, you can hit the dislike too. There's two thumbs there for a reason.
For two handsome men, you sure are dumb.
Yeah, exactly. I mean, I was disappointed they took the count on the dislike because I was trying to get as many dislikes as we were likes. But nevertheless, do that for us and keep the show going. We're here every Wednesday for 2 hours, people. Last year, 96 hours of free education. So we appreciate you doing that. Numbers jumped a little bit there, so thank you. But let's get back to some more questions here. Let's see. I saw one that I wanted to put up here, and now I don't see it. Here we go. Liz says, currently under contract with a new build out in Texas. Do you or do not have a specific close date, but should be around? I'm going to start over. They bought a house that looks to close in April. Should they lock the rate now, Josh? A year out. That's aggressive.
It's a long ways. You end up paying a ton. We have a client who's closing in November, and we priced it out in May. And if he had locked it, the rate would have been worse than what today's rates are. So we still made the right decision in not doing it. So when you look, the hedging cost for a rate for that long. We talked to we just had the comment pop up. Someone's at 3.75 and they've been locked and the house still doesn't close for a month. Rates haven't been 3.75 since January, February. So they had a 6-month lock at 3.75 and someone's paying for that. So from that perspective, you have to say, where do I think rates are going to be at that time? And probably the biggest question is talk to the lender. If it's the builder's lender, do you have a float down policy? If they have a float down policy that is somewhat reasonable, that as long as the rate drops at least 1/8%, that for the cost of 1/2 point in your pricing, not 1/2 point in the interest rate, but in the pricing, you can float down at least one time. If they have that float down option, I probably would lock it just to give yourself peace of mind that this is my worst case and we're hoping for the better. And the reality is, if they don't have a float down and you lock today at 5.75 or 6.25, whatever the number is, and rates are 4 3/4 when you close next year, they're not going to tell you, oh, you have to close at 6 or you're not going to close, because they know you're going to go, well, cool, I'm going to go to Joe's Mortgage down the street and Joe's giving me 4.75. So it can be a part of the builder lender process. I mean, they're making you apply with them. Take advantage of it. Lock, and if the market moves in your favor, have another lender lined up that can get you better terms if the market goes in your favor.
There you go. Good stuff. Nathan says, I'm going to start over again. I clearly have a hard time reading. I hear don't stretch yourself buying a house. How would you determine this? Closing on first house in Connecticut, 31% total debt to income, will have $15,000 in savings after the close. So to me, that's a relatively safe number. I feel like 31% debt to income, $15,000 in the bank. That's a reasonable, I don't feel like that's stretching yourself at all. Now, if you told me that you bought a $2 million home, I'd say you probably have a problem, but $15,000. I mean, if that's a couple of months of mortgage payments, I feel like that's safe. Josh, is there a number that you look for?
No, not necessarily. I mean, we're in Southern California. I pulled up this chart earlier when someone asked, what's reasonable? What can I afford? What's stretching yourself? There was another version of this question. So it's awesome that this came up. So I pulled up a chart, and the headline says Western states and Florida have the highest debt to income ratios. So if you look for us here in California, more than 60% of loans have greater than a 36% debt to income ratio.
Were you going
And
to throw something up on the screen, or are you just talking?
just talking.
Okay.
It's not the greatest chart, but it's kind of cool to look at. So again, for us in California, greater than 60% of loans have a higher than 36% debt to income ratio, and more than 26% of them are over 43%. So again, debt to income, no worries. 31% is great, but debt to income doesn't account for loss of a job, and it doesn't mean you get fired or laid off. What if you get in a car accident, can't work for 6 months, and you don't have disability insurance, or your disability is at a lower rate? 15,000 is not nothing, but again, Jeb, it comes down to, if that's a $3,000 house payment, that's 5 months. It's a pretty good cushion. I would rather, like, if we could sit here and manipulate these numbers, I'd rather have a 33% debt to income and $25,000 in the bank. But like Jeb said, you're in a reasonable spot. I don't love it, but we close loans for people at a 45% debt to income, and they have 2 weeks of spending money left over after we close. It's aggressive and it's risky, and that's some of that risk in FHA markets. Those are more of your FHA first-time buyers, higher debt to income, lower reserves. But in your situation, don't really have a problem with it. Obviously, more would always be better in terms of reserves, but you're in a good spot.
Good stuff. Andrew says median sales price went up from May to June. Despite higher rates, when do you think median sales prices will be pulled down by rates, Josh?
I don't know that they will. We've talked about this before. Home prices are sticky to the upside. So there's two parts to the equation. You may have buyers say, hey, I'm not going to pay that, but buyers have limited options. And many sellers, especially when they don't have to sell, are just going to say, well, I won't sell. This is the price that I wanted based off of the recent comparable sales. In terms of them coming down, I just don't see a big pull down in the number. Now, if you flash back, you asked us 6 months ago, neither of us projected rates to be at 6%. If rates are at 7.5%, 8.5% for your best qualified borrowers, prices for the homes that do sell have to come down. I expect we would see a lot less volume there because more people would be locked in. The only people selling would be the highly motivated sellers, and then you could see a drop. But we don't have forced sales. You may still have highly motivated sellers. I have a client, actually a listener to the show here. They bought last August, and now they're getting divorced. They have to sell the house. One of them has to buy the other one out, or they have to sell the house. So if the market says home's worth 10,000 less than what you paid for it, they have to do it, or 10,000 worth 10,000 less than last month, they have to accept it. But divorce, inheritance, death, moving for a job, those things are forced sales, and there will always be sales in the market because of that. But I think we're in a position where a lot of people are going to have a hard time saying, oh, I'll take less than the last person. So could it happen? Yeah, but it's not something that I necessarily expect. Well, let's watch. Let's see how the data plays out. If we peak at rates somewhere here in the low sixes, and in the next 6 months we're down at 5%, I don't think we're going to see any decrease. If rates go up, we could absolutely see it.
Well, if you understand how median works, right? So it's more houses selling above whatever the number is now to raise or keep that price the same. So if house prices just flatlined and didn't go up or down, but you had more people buying houses in areas, wherever that is above whatever that median price is, that median's still going to go up, even in a flat market, is because of how the median is, it's just more sales happening above that. So if Josh is accurate with the American Enterprise Institute article earlier, where the guy said the people at the lower end are going to be more affected, well, that means less sales happening at the lower end. And if people still continue to buy at that higher end, then that median is going to continue to stay where it is and or move sideways. So it, again, it's and Josh mentioned prices are sticky to the upside. Nobody wants to sell for less than their neighbor has sold for, or less than they think that their house is worth. And so unless they have to do it, people stay put. And I think that's more of what you're going to see.
And Jeb, a funny thing about the median is it works the opposite way. In the big downturn, the big real estate crash in 2007, 2008, median got crushed way more than if you were looking at Case-Shiller, which is a paired sales index, which is much more accurate. Case-Shiller looks at the same house selling over time. So same square footage, same bed and bath count, same neighborhood. So it's a statistically more valid number. That number came way down also, but nowhere near as much as median, because what happened is all of the activity was in the foreclosure homes at the low end of the market,
Right.
and median came way, way down when the actual measure of home prices didn't get hit quite as bad as what the median did.
All right, good stuff. Jose says, Rocket Mortgage has called me every day for the last week. They are getting desperate. So, yeah, I mean, a lot of these big companies that you see a lot of advertising for on the radio, on TV, on billboards, listen, they need the phones to ring and or outbound calls to close deals in order to keep that that ship moving forward. And so these companies are where the layoffs will happen. I mean, you've already seen, I think Rocket's already laid off a portion of their staff. It's going to get worse and worse. And all of, the Loan Depot, the big guys out there advertising are the ones affected, right? Because they got a lot of money on the line with budgets and advertising, marketing.
And what they started doing, Rocket, about the start of the year, it's trigger leads. So an interesting quirk is if you call me and we want to do a pre-approval, we pull your credit, the credit bureau gets to sell the fact that a mortgage company pulled your credit to the highest bidder. So Rocket's buying all of them. And if they have a phone number or an email or anything else they can tie it back to, they figured that maybe you didn't see them in any of their 9,000 TV commercials or radio ads or billboards or TV or a newspaper, so they needed to call you. So the only thing that I ask, I would never tell you not to call Rocket, because I think it's good and educational for you to do so. Call Rocket, get a loan estimate, and actually talk to someone local in your market. They are stunningly overpriced. And what you're getting for that is a relatively inexperienced person in a call center in a pretty cool system. They do have technology and that piece works well, but you're going to get put on an assembly line and you're going to pay a premium for it. So talk to them if you want to, but definitely make sure you're shopping and checking numbers with a local lender, because it's going to save you a ton of money.
All right. Jeff Lou says, what have you both seen with respect to the NorCal to OC migration pattern? Any predictions? So I've seen, I don't see many people going the other direction from Orange County north. It's typically people coming down from more expensive areas to more affordable areas here, which seems crazy based on where our prices are. But the Bay Area, outside of the Bay Area, Silicon Valley, all of that, housing is still very, very expensive. And so with people being able to work from home or only having to go in the office a couple of days a week, a lot of people have migrated over time to Orange County. So I don't know if the patterns are still quite as strong as they were during the pandemic. But I know that housing here, again, is still more affordable and you still have people that can work from home. So I think the move is still, NorCal to SoCal more so than anything else. But Josh, are you, any slowing, anything changing much there?
No, we do talk to a lot of people, and kind of the one that I always fall back to here on this is Eichler Homes. So Eichler is a mid-century modern architect, and we have them here in Southern California. They have them up in the Bay Area. They're literally the same homes. So it's a very good contrast. So in Orange, California here, a 4-bedroom, 2-bath, 1,900 square foot Eichler is on the market for $1,199,000. In Palo Alto, 4-bedroom, 2-bath, 1,600 square feet, 300 square feet smaller, is on the market for $2.99 million. So the Orange price is crazy. Like during the downturn, you could pick up an Eichler for $400,000, and now they're $1.2 million.
Didn't an Eichler sell for like 1.8 recently over in Orange?
Yeah, yeah, a really nice one. So, I mean, they're bitchin' homes if you're into mid-century modern. So that wasn't really where I was going with it. I just
Right.
like it because it's a direct comparison. People love in Southern California and in Northern California, they love Eichlers, and it's a good price comparison. They're the same damn homes, identical depending on how they've been upgraded, and you're seeing nearly double the price in the Bay Area. So there's a lot of people, Jeb, I don't know what your thoughts are on this, but wouldn't you say we see more people saying, I'm going to buy a rental property in Orange County and stay in the Bay Area? Most people don't want to
Yeah.
move. They
No,
like their market.
I've had a couple of those over the last couple of years. And in fact, I mean, they've all lived in San Jose, where they live, and they've bought down here in Orange County and bought rental property just to put their money somewhere. And they're both involved in tech. So I don't know, maybe there's a trend there, but yeah,
The
I think
thing,
it's definitely more NorCal to SoCal.
well, Jeb, think about what you said there, and it's sort of instructive for other things. We talk about every market is different. All real estate is local, so let's not talk about what's going to happen in home prices. Like a lot of the questions, like, what do you expect to happen in Orange County? Jeb and I can speak on that very well. But if we're saying the nationwide market, who knows? But what you said is really important. My sister in 1987 got married, and they lived in San Mateo. And the first time I went to San Jose, I'm like, I don't really like this. But I do remember looking around because I always had family in real estate. The homes were very similar to Orange County and very similar prices. Now San Jose is much higher prices. Even though Orange County is high, San Jose is even higher. And what's the difference? It's technology. They have a large volume of high paying jobs, and those people want homes. So it's just kind of just wanted to point out, pay attention to the industry around where you're living. We did an interview, Jeb, why am I drawing a blank with your friend, the realtor in
Oh,
the
John.
Phoenix?
Yep.
And John did a really good job of pointing out we have a lot of industry here. A lot of companies have moved here. A lot of jobs that didn't exist 10, 15 years ago when we had that last big downturn, it was because a lot of the people didn't have the high paying jobs. We have more high paying jobs. So look in your area. Atlanta has benefited from that. Dallas, Fort Worth area has benefited from it. Austin has benefited from it. I was in Austin last week, and you're kind of like mind boggled at how many new office buildings are going up and how many big name companies have moved out there with high paying jobs, and you see what's happened to their home prices because of that.
Agreed. Agreed. So let's see what we got here. So the Lone Star, what do you think about institutional investors buying up 50% of the Phoenix, Dallas, Fort Worth, and Atlanta markets, driving up prices? So I don't know if 50% is an accurate number for institutional investors buying up property, but I mean, what I think about it is, I mean, it definitely exacerbates the problem that we have with low inventory. Um, but there's nothing you can do about it. I mean, so no sense in, I mean, it's one of those things that like you can't control it. So why concern yourself with it? I mean, it's not great, whatever. It is what it is. People are looking for, if they're looking for appreciation, they're looking for, a fixed income, and real estate provides that. And so if they can buy a bunch of property, rent it out, and provide their investors with a stable fixed return, they do well, their clients do well, and everything continues to, kind of move on with regards to that industry. So I don't know whether or not I think it's fair. It is what it is. So I don't, Josh, what do you, anything you want to add on institutional investors?
I was on a live last night with a couple of my friends from around the country, and I was kind of surprised to hear that in Michigan they've had a ton of this. You hear it more like the markets we're talking about: Phoenix, DFW, Atlanta. We know that the institutional buyers are there, but he had pointed out they're next door to Canada. Canada put some serious restrictions on institutional buying.
Oh yeah,
In
recently
in
too.
in general, I don't love government intervention, but this is getting silly because the stuff that's being taken out of the market is the stuff that we need the most.
Yep.
It's literally like you're allowing the people with the deepest pockets to take not the most valuable things. It's not like they're out buying the Rolls Royces, they're buying the freaking Hondas that everyone needs, and we have a shortage of them. So I would be in favor of severely limiting institutional buying, just because it's such a problem for us right
But
now.
the
And housing is
problem
one.
you have there is the people that are making the decisions are the ones also benefiting from the institutional investors with regards to deep pockets and politics and being voted into office. And so it's, I don't want to say the system's rigged because that it's very pessimistic, but at the end of the day, it's one big, the institutional investors are the ones getting the people into office that are making the decisions on housing. Therefore, this stuff's never going to change people. I don't know. That's my thoughts. Maybe it does, but yeah, I'm a little bit pessimistic on it. In Canada, what they've done is, they had a lot of foreign buyers, a lot of Asian, Chinese money come into Canada, and that's what drove a lot of the prices up. And so they're actually implemented something where if you have a vacant property in Canada, you're going to be taxed on that vacancy. And if you don't rent it out, it has to become a rental. And if it doesn't, I forget what it is. If you decide not to rent it out, or for whatever, I forget exactly how it works, you're actually going to be taxed on that property. The thing with institutional investors here is most of them, it's local, U.S. money versus being foreign buyers, I think, at this point in the game. But I don't know. That's a whole different conversation. We could talk about it and really get nowhere, because something has to change for that to change. Josh says, so do you think the American dream is in danger with corporations sweeping up houses to safeguard their assets? I think that's pretty much what we just discussed. I have real fears that we're going to be a renters nation. Yeah. I mean, again, yes, I don't disagree with that. It creates a larger gap in I wouldn't say equality, but between the wealthy and those at the lower end. And again, it's something has to be done. I just don't know what can be done.
Jeb, we talked earlier about academics at the Fed. People have never been out in the real world, said, okay, hey, we have to act. So let's buy mortgage-backed securities. It's going to help houses. We're going to stimulate into a rough patch during COVID for the economy. Everyone that owns a home is going to be able to drop their payment. Rates went from, median rate was just around 4 down to like 3 1/8, 3 1/4, something like that for actual loans on homes, not what was available in the market. And that's a fact. The average household, I don't have the exact numbers, I think it was a couple $100 a month, the average homeowner household saved. But if you were not a homeowner, you didn't benefit from that. And as a matter of fact, not only did you not benefit, you got taxed as home prices went up. And that homeowner that has a lower payment, including me and Jeb and anyone else on here that owns a home, gets a lower monthly payment and higher appreciation, has built their net worth, all while politicians, also mainly academics, also mainly wealthy people, insulated from any of the real world, are talking about inequality and causing inequality at the same time. So it's a problem. And much like Jeb just said 3 minutes ago, I don't know the answer. I don't have one, but we see it every day. I talk to more and more people. Like, my phone doesn't ring less and my email box isn't less full, but we are doing less loans this year because a lot of those people we talk to can't buy, or they can't buy what they want to buy, so they're going to continue to rent, or they're going to move out of state. Everyone wants to own a home. I mean, that's a giant generalization. Not everyone. Nearly all people at the right point in their life want to own. When we take that away from them, it's not just purely an investment and having equity or being able to, decorate your house wherever you want. There's 1,000,001 reasons why the vast majority of Americans would prefer to own their home. And we need to figure out how to make that a reality. And the numbers are just difficult right now.
And Josh has another question here. It says, investment property or home for myself first. I have no family to live with and sick of paying rent, but I'm thinking cash flow is better than self-investment in this current economy. So first thing I would say is, can you find a property that will cash flow? That's, in some markets, that's tough, right? Coming to California, very difficult to find a property that's going to cash flow unless you have a huge, a large down payment. So that's something you need to consider. But Josh, what are your thoughts on investment property or home for yourself? I mean, maybe a duplex, maybe a triplex, something where you can live in one of the units, rent the other 2, 3 out in order to help you cover the mortgage. Always a good opportunity there for a first-time home buyer if you can find the right property. The thing with, go ahead.
I was going to say 3 and 4 units can be very difficult because it's going to require 25% down if you go with conventional financing. Portfolio lenders may do it at 20%, but FHA allows 3.5%. But most places, rent prices haven't kept up with home values. So FHA has a self-sufficiency test in their guidelines, which says that the rents from all 3 or all 4 units, even though you're going to live in one, multiplied by 75% to allow for a vacancy and maintenance factor has to exceed the mortgage payment. And with rates higher now, hardly anywhere passes the self-sufficiency test. So I agree 100%, Jeb. It's a great idea for a first-time buyer to get a duplex, to get a 3 or 4 unit, because their cost of shelter is less. They can sort of control a more expensive property, get better benefit from the appreciation, but it's really hard financially to make that happen. But the bigger question here, Jeb, is I've had a couple people here call recently, hey, I can't afford to buy, I want to buy an investment property. You go, okay, that's a single
larger
family
down
home
payment.
is going to be at least 15% down with expensive mortgage insurance and an expensive rate. So your cash flow doesn't work from that perspective. You still have to own or rent a place to put a roof over your head. And because about 3-4 years ago, when home prices really started going up again, we were having reverse occupancy fraud. So people think of saying, hey, I want to say I'm going to live in the property so I can get a lower interest rate. People were going to live in the home but didn't qualify. They said, oh, I'm not going to live in it, I'm going to rent it out. They were happy to pay the higher interest rate just to get the home so they could use rents to offset the payment and qualify. So now there's some pretty serious restrictions on that. It's very difficult to qualify for an investment property when you don't already own a home. So I would go back to what Jeb said. Units, probably FHA duplex is the best and easiest button to kind of get you the best of both worlds there. Not an easy market. No, still no easy markets with even with things cooling, but that's a good way for you to take advantage of both.
Well, you said something important that I didn't even, register with me, is that if you buy an investment property and you're not in units, you still have to pay rent somewhere, right? So what's the benefit of owning a property and somebody paying you rent unless you can get some, crazy amount of cash flow on that property to help offset your current rent? But it's got to make sense. And so, like Josh would say, the numbers never lie. So run it both ways and you'll find out pretty quickly whether or not it's something you should consider.
Here's a follow-up question, and it's sort of what I meant to include in that answer. So Andrew says, Josh, not this Josh, Josh
Right.
had asked the question, plan B, buy a single family with a section that can be Airbnb to give you some cash flow. We have this whole idea of house hacking, lots of YouTube videos on how to do this. If you can qualify and get in and you're cool renting a couple rooms, Freddie, our listener, I don't know if he watches anymore because he got his home, but he rents. If you guys remember, he bought an FHA. 7 months later, we put him into a conventional loan, got rid of his mortgage insurance. He stays in the master. He rents 2 or 3 of the other rooms out and hardly pays anything for the house. So it can be a great strategy, but you still have to get in and qualify, because even though your 2 best friends are going to live with you and pay you $1,000 a month rent rather than renting an apartment, we can't use that to qualify. But the Airbnb piece, very similar. You can't use that to qualify, but if you have a section of the home that you can throw up on Airbnb and you can do your research and get comfortable with it, I'm in favor of doing whatever you have to do. In a perfect world, I was not that guy. I didn't want people, I'm private. I like to be quiet. I don't like people in my space. But if you can do it and it enables you to become a homeowner in this market, I would absolutely be in favor of any of these options that people are throwing out.
All right. Let's see. I don't know what they're talking about there, so we'll just continue to move along. Let's see. So I'm going to ask again that you guys hit the like and subscribe. We've been on hour and 23 minutes. It's that time in the show. And also, guys, didn't mention it at the beginning, looking for topics on the Educated Home Buyer, the podcast, which is separate from this. If you go out and look at any of your podcast platforms, it looks like that little logo up there in the top right-hand corner. This last week's episode, we talked about HOAs. Week before, we talked about single families versus townhomes, condos. Really want to provide the information that you guys want. It's 30 or so minutes deep dive into a topic. And so, if we're just talking about things we want to talk about, you guys don't benefit unless, we end up covering something that you had no idea you wanted to know. So leave us, a comment here, guys. Let us know what you want to hear if you're a listener of the show. If you haven't, listen to the show. Let us know what you think. Anything you want to add on that one, Josh?
Just in terms of the podcast, no, anything you guys want to hear, Jeb and I would be happy to cover. And the cool thing about that format, especially if you guys throw an idea up here, it's sometimes a little bit difficult here just off the cuff to come up with an answer. We can Google something really quickly, but give us a couple of hours to do our research and we can go deep on just about anything that you guys want to know.
Good stuff. What's the luxury market going to do in this market? So it's a good question. Luxury market is going to slow, just like everything else is going to slow. Days on the market for luxury properties is typically way higher than that of entry level homes. So you're going to see homes sitting on the market longer there. You'll see bigger price cuts on those properties because, again, a larger price cut on a more expensive home is the percentage. The number might seem large with the price cut, but the percentage that it's being cut is usually pretty relative to the lower end price points as well, just depending on how their prices start. But it's going to be no different. But what I can tell you is there's still a lot of cash out there. In fact, I was in my office yesterday talking to an agent in my office, and she just listed a property in Santa Monica at $4 million. Actually listed it at 3.5. They had 7 offers, and it countered 6 of them. Out of the 6, 4 of them were cash, and it ended up selling for over $4 million. So it sold for $500,000 over the asking price. I don't know what the number was exactly, but 4 of the 6 or 7 offers were cash. So there's still a lot of money out there, a lot of, and she said out of those 4 offers, a couple of them were portfolios of people that had somewhere between 15 and $20 million they were looking to park in real estate. So that tells me, now that's LA, that's a little bit different market, but there's money out there that is looking to go from maybe equities, maybe go from different, asset classes into real estate. Why? Because it's stable, again, fixed returns, whatever the reasons that you want to invest in real estate, but there's still a lot of big money out there headed that direction. It's hard to say what's going to happen in luxury. Luxury is one of those spaces where it's really less about what the comparables have sold for and more about somebody finding value in whatever that property is at that level, right? I mean, some of these properties sell for numbers that, just arbitrarily made up for whatever reason, says, hey, this is the number. And then it ends up selling, maybe somewhere close to that number or above or whatever, just because somebody finds value in it. So again, it don't know for sure, but it's going to follow. It's going to follow, real estate at the lower end. Typically the luxury space gets hit first. But I don't know that we've seen it this time because, again, there's so many people looking to park money in real estate, even at the higher end. Josh,
Well,
anything on luxury?
not only wanting to park money, they've been insulated from some of the issues that other people are having,
Well,
and
that's true.
the wealth effect has been so big. Kind of to your point, they have large chunks of cash. The last couple of years have been really good for people with assets. So if you're sitting on a windfall, buying a bitchin' property isn't as hard to do. So yeah, typically we're not seeing what we typically see.
Well, that and a lot of the people buying again some of these people are move up buyers, and they're taking money that they've made over the last couple of years in real estate and able to transfer that. So a lot of those people are less affected because they have the money coming from other places to do it. And that's one thing that is going to affect that entry level buyers. They don't have the large down payment. So, yes, rates are higher, but some buyers are able to just say, you know what, absorb it because now they've taken such a large chunk out of whatever they're selling, or maybe pulled some cash out of a property because of that appreciation and able to put it forward. The payment may be more expensive than they wanted, but they also have more down than they would have had otherwise. So it'll be interesting. I mean, obviously the next 6-8 months will be pretty telling across the board.
This would be better for an interview format, but we're always looking for new questions. So builder sip. I thought it was builder chip or builder clip, but it's builder sip.
Yep.
With a recently acquired dual citizenship, I just bought 4 more lots to build in Rosarito, Mexico. I currently own an Airbnb there and now plan on building apartments to rent to new gringos. This sounds crazy. When I say this, it sounds crazy saying it, but I listened to a podcast with a girl the other day that moved full time down to Baja, and she makes $35,000 a year, and she lives well there, not living so great in America or California. The dual citizenship thing here really helps. For those of you that don't know, the Mexican government makes it really hard for Americans to own property. They do it with leases. They change the rules, but there's a lot of this going on. More expats than ever. Spanish is not a difficult language to learn. If you haven't already picked it up, we're surrounded by it here in California and Florida and Texas. So it's an interesting trend of people moving down there, retiring down there. This was the first time I'd heard a younger person. We hear Puerto Rico, but a lot of this stuff, I mean, that can impact things longer term also. If you can take your job with you and you can go somewhere in Mexico with a good internet connection and do your job in America, you can live a lot better.
Good stuff. Good stuff. We got Kevin saying that insight into Freddie Mac letting single family home buyers use ADU rental income to qualify would be a great topic. So Josh, put that one on there. We could talk about some guidelines.
Let's just do a whole episode, or even a couple of episodes on ADUs, because it's a big thing. People want ADUs to sort of help in terms of affordability. So it's a great topic.
And understand, people, that's another reason that people are going to stay put, right? I mean, now with these ADU laws and buyers having, or homeowners rather, having super low rates in, people don't want to move. So what do? They try to find another way to add on, right? We had somebody earlier ask about home equity lines of credit to do an addition. And I don't know where that question disappeared to. Maybe it's still in our queue here. But people are going to find ways to add on or do the ADU, bring in income and that sort of thing, right? Keep that mortgage where it is, that first mortgage, and do things to add on to the value of their property so they don't have to get rid of that loan at the super low rate they have locked in. And California has made some of these laws that are friendly that allow for ADUs. So bigger lots, and those types of properties are going to sell for a premium because there's a lot of people out there looking to take advantage of some of this stuff. Now, Josh, did you see that question I had earlier?
We ask a question.
Oh, here it was.
They give us a hell of an assignment because the ADU stuff is new and changing and detailed, but we'll absolutely cover it for you guys.
So Mr. Ram fan from 1982, he outgrew his current home and got priced out of the current market. Would you suggest a HELOC or a HELoan for an addition? So what this person's saying, this gentleman's saying, is that it's got a current loan that's locked in, probably at a super low interest rate, been priced out of having to be able to buy anything in this market. So can he pull some cash out of his property by doing a home equity line of credit or a loan in addition to his current mortgage, a second mortgage, if you will, to pull out that equity? So Josh, what are your thoughts on that?
It all depends on where you think interest rates are going to end up. An important thing to know with the home equity line of credit, like credit cards, the Fed does control that directly. We talk about mortgage rates that are not directly impacted by Fed moves. But next month, when the Fed increases 0.75%, home equity lines are going to go up 0.75%. If they get where they want to through the rest of the year, you're going to be 2% higher by the end of the year. The home equity loan is a fixed rate, and a fixed repayment period. So you don't have the benefit of that interest only, the benefit or the downside of the interest only period. So you're going to have a higher payment, you're going to have a higher interest rate in the short run. But a few folks that I talked to earlier in the year, we don't really do a whole heck of a lot of seconds. We don't have great sources for it. But when I talked to them earlier in the year, I'm telling them, hey, I'd take the home equity loan at 5.75 because your HELOC is going to be higher than that by the end of the year. And they're like, oh, that's crazy. And they took out the HELOC and now wish they had a loan. So the primary benefits to the HELOC is, for the draw period, most HELOCs will have an interest-only payment, so the payment's going to be lower. It's going to start at a lower interest rate, and you don't have to pay interest on it until you actually borrow it. So say you're building an ADU, you take out $100,000, you're only paying interest as you're paying out the money. Those are the benefits to it. The downside is it's variable. The downside is after that interest-only draw period, which is usually 10, sometimes 15 years, you have a 10 to 15-year repayment period with a fully amortizing payment. And the variable rate is probably the biggest thing about it, the biggest downside to it. So think it through what you're going to use the money for, how quickly you're going to use it for. I lean towards the home equity loan, but I certainly understand why a lot of people are going with a home equity line of credit.
Good stuff. So I had a couple people in the chat reach out and ask about getting connected to Josh and or myself. So I put some links up here on the screen. If you're in our local market, obviously it's pretty easy to have the conversation, but maybe you're out of state and still want an expert opinion. That link will allow you to connect with us, can have that consultation and get you the information that you need. And if you want to get connected with Josh directly and or a lender anywhere in the United States and or a real estate agent, you can use that link at the bottom there, the jebsmith.net referral link. It'll get you connected to an expert, whether you're looking for a loan or a real estate agent. So hopefully for those that you were looking for that, that gives you the information that you need. Josh, so one thing you and I talked about yesterday, and I put it out on the community forum on YouTube, was asking people if we did another YouTube channel separately from what I have now, maybe a Jeb and Josh combined thing where every single day we do a 15 to 30 minute live talking about.
They all checked out it every day. They're like,
real estate.
The answer is no.
So I just want to know, is there any interest? Do you watch any channels where people do a live every day? That's all they do. So the channel would be no pre-recorded videos. It would just be what's happening that day. You guys see any value in that at all? Leave it in the comments. I mean, I'm just curious to know what people think about that sort of thing.
And so, the thought process there is, we talk a lot about, Jeb, did you see this report? Did you see this piece of news? So if you go back, if you're old like us and you remember when people started blogging and they'd have their blog roll over to the side so you could see the things they're reading, we're basically going to give the daily analysis of the 5 to 7 things that both of us go through every day. Do not necessarily a deep dive, but a little bit of analysis on it, give you the links so you can read through it so you'll know what we're looking at. Again, Jeb and I don't have crystal balls. We do a lot of research.
How do you know
what
do you know
your wife told me that Jeb does not have crystal balls. So from that perspective, it allows you to read the same things we're reading, and maybe you analyze it differently. Maybe you look at it and go, hey, those guys are nuts. But at least you can look over our shoulder and see the stuff that we're going through and analyzing when we come to these thoughts.
So Jennifer Lego was a hard no. So this wouldn't need a moderator, people. This would be people could comment, but there would be very little question taking. Does
Jennifer have a day job where she's not allowed to jump on with
I think she's like a doctor or a nurse or something. So she's basically saying that she doesn't want to do that at work, is what I'm getting from this. The pay here isn't great. So Jonathan has a question, says rentals are up 10 to 15% in Orange County and are as competitive as home buying. Yes, they are. Should I renew at 5% rent raise in Irvine and wait, or purchase a home with a 5% down payment in the $800,000 to $900,000 range? So I would tell you, if you can, again, you can afford the payment between $800,000 and $900,000 and buy now, I think long term it's a better move versus continuing to rent. I don't know that renting, even only going up by 5%. I don't even know what your rent is, but I have an idea of where you're living in Irvine about what it is. Irvine is probably one of the more desirable cities in Orange County for many reasons. The values there are really sticky to the upside. There's huge demand for people wanting to be there. So I don't know if you can get into Irvine market if that's where you're looking, but if you are, I would say that, I think buying is better than renting for many reasons that we've talked about here before, but that to me is the right move, but it's got to make sense to you, right? In your life and be affordable and all of that good stuff.
And really a lot of this comes back to that. Is it the right point in your life, and are you stable, and do you have that 5 to 7 year time horizon? Jeb's gone through it. I've gone through it many a time, but I have zero worries for someone buying today that has that perspective, because you're going to pay the house down in the next 7 years. It's going to be worth more than what it is today. It may not go up a ton. It may not look great relative to the last 7 years, but you're going to have all of the benefits of owning a home and home ownership. So from that perspective, if you want to buy and you have a long-term perspective and it's the right time, there's nothing about this market that tells me I wouldn't do it. Would I have rather done it 2 years ago? Yes. Would I have rather done it 9 years ago? Yes. But we can't go back and change the past. You can only act in the present.
There you go. Very profound.
I try.
Avotion. I have no idea. The flip market is concerning in Tampa. I'm seeing these flippers trying to pull $60,000 in equity after $10,000 in upgrades. Within 2 months of their purchase, it's back on upside down on the loan is a fear. So I will tell you, I see the future of some of these flippers out there. These guys are going to get hammered. because they're buying properties at prices that are well above what they probably should be paying, and thinking that they can still squeak out some of these values. It's going to happen. We've even seen it in this market, people overpaying for property. They've gotten away with it because the market appreciated so much within a short period of time, but that's not going to be the case going forward. So there's going to be some flippers out there that bought property that, took too long to redo it and are going to end up getting, maybe they don't end up having to sell it for less, but they're not going to walk away with what they think they are. Josh, what are you seeing in the wholesale flipping market?
I agree with you on that. And I think it's important to know, did the person start flipping, like if you're flipping in the down market when there's an opportunity because home prices are cheap, and you're flipping knowing that you have to make a really nice product to sell in a high supply market, it's very different. When we were doing things in 2008, 2009, 2010, you better make those houses nice because there's 14 foreclosures on the street at a much lower price point that the person can buy. It rapidly, by 2011, 2012, 2013, it was who can do the least work to get a decent margin on it and just churn and burn and move on. So just be careful who you're buying from, what you're looking at if you're considering a flip home. But in this question, I always go back to, we get a lot of comments when people were having to overbid, waive appraisals, people talking about they're paying way more than fair market value. The market dictates what the price is. I made my profits flipping homes when I bought them. Had nothing to do with how much I put into them. Some of them we put $100,000 into, some of them we put $22,000 into. We made the money on the buy. So the buy plus whatever work you put into it, and then the market value is going to dictate. So I wouldn't say, hey, someone only put $10,000 of upgrades and they want to get $60,000 out of it. If they made a smoke and buy, hey, good for them. That house I bought last year for $500,000, we put $110,000, $120,000 into it, and today it's worth $925,000, $950,000. So you say, oh, this lunatic wants $300,000 in a year. Well, no, we made a really good buy. We did a really nice job fixing it up, and the market went crazy. So here we are sitting on that. The market is always going to tell you what it is. So you could be absolutely right that it's a crazy flipper that's never going to get that amount of money. But the fact that they only put 10 grand in and they might profit $60,000 tells you nothing about how the market values that home.
Good stuff. Good stuff. Let's see here. Let's see.
Here's actually a good one, Jeb.
Yeah,
I'm going to read it. You're going to answer it. Currently in escrow for a new home, but we have to sell our current home first. It's been listed for a week, but we've not had a single offer. We already listed $60K under value. I'm not sure what value is. Advice, back out.
It's a week. There's nothing to worry about. Like, no concern, zero. I don't even know where your property is, what its price. 1 week, there's no cause for concern. Understand. I mean, the market is changing. It's shifting. It's slowing down. I don't know what the average days on market in your market is, but I mean, here locally, it's like 35 days or so. Home sits on the market for a week, no showings. No cause for concern initially. You just got to continue to watch it, continue to see what's happening around you, what's happening with the comparables. If you're priced, again, you're saying you're priced $60,000 under value. I mean, where are you getting the $60,000 under value from? Where's that number coming from? Was that a home that sold, 4 months ago and, before rates went up? Then maybe you're not priced $60,000 below market value. In fact, I have one at the moment that's priced, about $60,000 under a property that sold 4 months ago. It's a different market 4 months ago. Rates were a lot lower then, right? So it's all relative. But the key here is 1 week. 1 week, there's no concern. I don't care what market you're in. So just continue to watch it.
Best example I have, Jeb, I got a client right now that I thought it was nuts. In a very tight market, they were able to get a contingent offer accepted, and they hadn't listed the house. Listed it the day after they got it accepted at a very aggressive price. Aggressive meaning they wanted top dollar for it. And it's out in the high desert. And we're looking going, this will be interesting. Rates are going up. It's a high desert market, a tight affordability market with prices up as much as it is. And they had to do 2 price cuts their seller hung in with them for 35 days while it took to get their house on the market or under contract, and they did get the house sold, and we closed yesterday or maybe this morning on their home because they walked away with just enough money to finish the new purchase. So everything you said, Jeb, sellers have been spoiled in terms of what their expectations are of how quickly a home
But
should
it's
sell.
part of the realtor's job to set those expectations now in a changing market, right? It's part of having that conversation that says, hey, listen, if your realtor's panicking, you got a problem. That one, maybe the wrong realtor, but one, maybe they don't understand the market or understand how things work. There's a lot of agents out there that haven't been an agent in a normal market where properties don't sell immediately. I mean, during the last housing crash in '08, homes sit on the market 6, 7, 8 months. Some of these things, hell, some of them were a year. You're talking about having difficult conversations. Those conversations sucked versus a property hasn't sold in a week. No, come on. Let's see what we got here. So I saw a question I was going to click on and I lost it. It was asking about tax returns. Josh, the question was, what line on a tax return does an underwriter look at for income? It's the adjusted gross income, right?
An underwriter doesn't look at your adjusted gross income. They're not even necessarily looking at the tax return. Each piece of it has to be analyzed. So if you're self-employed, they're going to look at the Schedule C and analyze that. There are certain things that can be added back, depreciation, depletion, the depreciation portion of the auto expense. We have to take away, again, this year, now that half of your meal expenses are not deductible. So there's a full analysis of the tax return for a self-employed person. And if you're not self-employed and you're a W-2 employee, they're not looking at the adjusted gross income of what you earned last year. They're analyzing pay stubs, W-2s, verification of employment to see what you're going to make this year and moving forward. Variable income sometimes needs to be averaged. There's any number of ways that you need to work with that and handle it.
I see that you had commented about reaching out to you. So
It's just,
reach out to Josh.
and Drew and I've talked before, so we need to go a little deeper on it to get an accurate answer for you.
All right, so we got 2 questions here that I think are both good questions, especially regarding rates. So if you're somebody out there that understands rates or interested in rates, these are questions that I feel like are good questions. Why is it that jumbo rates are lower than conforming rates, Josh?
Generally stricter underwriting standards, and they're not a ton lower depending on where you're going. They're lower, but they're more difficult to qualify for. So from the lender's perspective, there's a lower risk of default. They don't have the benefit. Generally, why have Fannie Freddie rates been lower than jumbo loans is because they can be packaged and sold. It's easier for the lender to not have to hold on to them. But the secondary markets for mortgages are saying, hey, we would rather have the security of slightly larger loans with higher credit scores, lower loan to values than what we're seeing in your normal Fannie Freddie stuff.
And I feel like that's a pretty like high level question for such a young lady.
she's quite young.
She is quite young, but she's looking to get the education to be a home buyer. Clearly, Brandon says lenders charging almost 2 points to extend my rate lock. Wouldn't it be better just to let the rate expire and get a new rate with a 2-point buy down? Josh, can you just let your rate expire and immediately relock it and pay the 2 points to buy down the rate?
I love the question. You absolutely can do that. The question becomes, how long do we need to lock? So I think it was a new construction, right? It just got pushed out because he had asked the question and then kind of gave us more detail as he went. As long as we know that, say, hey, in the next 30 days it's going to be closed, fantastic. You're going to do just fine there by going, okay, here's my current lock, here's what the cost is, here's if I take that cost to current pricing. And the lender should be able to do that for you and tell you if it's more beneficial to go that route. We are always doing that calculus when we're coming to the end. We talked earlier in the show, do I need to extend now? Well, my rate lock expires on July 12th when it's supposed to be finished on the 13th. Well, we usually wait till the very last moment and you look at it and you see, where is the market now? what does it cost if we go to worst case and relock? What does it cost to extend? And which of those is better? So you're absolutely right that you need your lender to just walk you through that of saying, what does it look like if I'm going to expire tomorrow? What does the extension look like? What does relocking at worst case, and which one's cheaper for me?
There you go. Devi says, is a HELOC a good idea to add square footage to a primary home or sell the small primary home and move up into the bigger house in the same area? So good question. I would say, can you find what you want in your area? Can you find the move up home, and is it affordable? If you can, I think that's the better move. But with that, maybe you're paying more property. If you're in California, that means you're paying more property tax. I mean, all the expenses go up. But typically speaking, if you can find the house that already has the work done, it's going to be a little bit more enjoyable process versus dealing with construction and contractors and overbids and things being more expensive than you probably thought they were. It's one of those scenarios, to each his own, but it's usually cheaper to do the work. Maybe not in this market, but historically speaking, it's usually cheaper to add the square footage versus going out and trying to buy the house that has it. But if you can find the house that has it, that to me is the right move. That's what I would consider over the other option.
I would lean towards the same. The two things that came to my mind is, Jeb, exactly what you said. In a normal market, you can build and kind of do it the way you want. Last few years, contractors have been super busy. It's been nuts, been difficult dealing with them. And then the other thing is, most people, it's not in their wheelhouse to manage a project, to pick materials, to work with a contractor, and the ability to just walk right into a home and have it done. Generally, for most people, is the better route, but there's a million other things to consider there in terms of your current rate, your current property, new rate, all that fun stuff.
All right. Wisdom Tube says, what do you think about Charlotte housing market? I have some buddies that actually they own a couple different businesses in Charlotte. I know the market there's been crazy. I do think it's slowing down, like a lot of the United States is at the moment, just a changing market, but honestly not there enough to give you any real insight on that. There's a handful of YouTubers out there, some with successful channels that follow the Charlotte market. So a little bit of a YouTube search will find you somebody. Just find somebody you can trust and understands the market. Get you that info. David says, I know you guys are residential, but I think talking about commercial real estate news or issues would be a great addition to the First Time Home Buyer podcast. So I like that, Josh. Maybe get somebody on there that knows commercial and understands commercial, because I mean, commercial doesn't directly affect residential, but there are some similarities in those. And if you see a slowdown in one, which with a recession coming, you might see more of a slowdown in the commercial space, in leasing and buying properties. But I don't know. But I do think it's good to, even if you're a home buyer, residential home buyer, it's good to understand the macro view of all real estate. It just makes you more educated. And that's the goal. So yeah, no, David, I appreciate that. You're freezing on me. What's going on over there?
You left. I don't know if he's buying the business, the building.
Oh, no. Okay. So he says he's buying, I didn't talk about the Red Robin part, but I'm assuming buying.
No, what I'm saying is that's the important part, because hopefully he has some input, because Red Robin used to be fantastic and now they're all going downhill. So hopefully he can turn it around or force his new tenant to do,
the French fries
to do
are
a better
delicious,
job.
though. Just saying. Delicious French fries. And they don't stop. They just keep bringing them. I mean, it's great.
Yeah.
The best concept ever. If you're going to open a restaurant, just give me free French fries. It's great.
I like it.
People probably wondering, what the hell's Red Robin? Let's see what we got here. We are an hour and 53 minutes in. Josh, have you seen any sellers paying buyers closing costs recently? I haven't seen any of it personally. I've talked about some videos where sellers can start paying points and doing some other things. In fact, I have a video that's coming out tomorrow. I don't know when I have it scheduled, maybe tomorrow, maybe Friday, where I talk about this in more detail. I haven't seen it personally, but I will say you're going to see more of it, just because as properties sit a little bit longer, sellers want to sell, they're going to be willing to work with offers that are asking for credits towards closing costs. But Josh, have you seen
Jeb,
any?
you and your channel indirectly brought it into being. Lucy, one of the viewers here that's commented multiple times, we're helping her with a place up in Northern California. And she came to me with a plan and said, hey, I've found the property. It's been on the market a while, had a price reduction. I want to get in. I'm just going to take the 3.5% for the FHA from my 401k as a loan, and I want the seller to pay everything else. She got a really good agent on her side, and it took some back and forth, but we literally got the sellers to pay everything. So all prepaids, all closing costs. She's getting in with her 3.5% down. We just got the loan approval this afternoon. Again, that call I was on last night, loan officer in Texas and a loan officer in Michigan, and both of them said, is it common? No, but definitely starting to see it. And none of us had seen it for the last 18 months. So still not common, but sellers are seeing it as a way to move their home without cutting their price, or just get it on into escrow faster than sitting around waiting for someone to make a full price offer with no concessions.
All right, good stuff. Let's see. Let's take a couple more questions here if we can find one, Josh. I don't really see a lot. Here we go. We'll go Determinator. I've heard that each increase in percentage point decreases affordability by 13%. Wouldn't prices for houses sold by motivated sellers need to come down?
How many motivated sellers do we have?
I don't know. And who's to say that you don't have a buyer that's willing or able to pay that increase in 13% of affordability? I mean, prices again here in Orange County, the payment has gone up 45% for many buyers out there because of where rates are. There are still people buying. There are clearly people that are priced out too. So until you get to a point when, again, the demand is lower or is higher than the supply is lower than the demand, then no, supply is lower than
higher.
Yeah, supply is higher than demand.
You'll get to it. We're
yeah, there we go. Eventually, my mind's not working. Then you don't have people that have to do anything, right? I mean, I realize inventory is increasing and things are slower, but people, let's understand that does not immediately mean that sellers have to accept something lower or that the market has to have some big price correction. I just went off the screen there. Josh, did I die? I died.
Did your phone? Did your camera die?
I did. It did die. Holy
we have the ghost of Jeb answering questions.
Well, you do your thing, dude. I'm going to plug back in here.
Well, this is what I told you. You need one of those fancy plugged-in pseudo batteries that I have here. You don't ever have to worry about that.
Well, I guess not. Well, hell, this is fun. How do you guys like this? A show with no actual host.
How long does it take the host to plug in a new battery?
What do we got?
I see a round there.
We got to do. That's a different camera. We got this camera. We could go to that camera if we wanted. All right, just go talk. I don't know. I'll try to add the other one back in here if we can. There we go, people. Sorry.
Now they see the glowing amateur purple tree is what lights your head up.
Amateur hour. So did we finish that question? I have no idea. I went out.
For the most part, you got through it.
All right. So guys, this is what we're going to do here. We are going to ask again for some favors, like we always do towards the end of the show. It's been 2 hours. Before we do that though, I'm going to give you a link here at the bottom of the screen that if you want to get connected with a lender, with a real estate professional anywhere in the country, you want to get in touch with Josh, you can fill out that link below. It'll get you there to where you need to go. If you haven't already, ask that you hit the thumbs up and, follow us, share us, watch us. Again, 2 hours every week, a lot of free content, a lot of free education. Don't really ask for anything. In fact, I don't know that either of us make any money by being here. In fact, we probably lose money based on what we earn an hour to be here. So, hit the thumbs up. It helps. And lastly, I'll put some information up here if you want to get in touch with Josh or myself. have a consultation, a deep dive into something that's going on. Josh, any parting words this evening?
No, interesting times. So ask your questions, do your research, make up your own opinions, and make good decisions.
Wow. Very profound. Don't come here looking for advice. You make your own decisions. You understand me?
Figure it out.
Yeah, you guys figure it out, then host a YouTube channel. We're going to watch you for the answers. No, but guys, we do appreciate you being here. I finally feel better after 2 weeks after COVID. I mean, it literally took everything. I had an IV yesterday, one of the vitamins and all that crap. Dude, I'm telling you, it worked a miracle. Like today's the first day I don't feel like somewhat foggy. So I recommend it. If there's any sponsors out there, it was expensive. It was over $205 for that damn thing, dude. But I would have paid it again. I'll pay it again if I feel like hell again, just so you know. So I need a sponsor. Anyway, no, guys, we appreciate you being here. We'll be back next Wednesday with another 2 hours. If we can help you before, reach out. Until then, adios.